The Maverick Podcast. Welcome back to the Maverick Podcast, the show where markets meet mayhem and history hits like a freight train. I'm your host, and today we're diving into one of the wildest financial roller coasters America has ever seen. Picture this: banks failing, mobs on Fifth Avenue, interest rates spiking to 150%, and one man, yes, just one, standing between Wall Street and total collapse. This is the panic of 1907. And the story of how J.P. Morgan, the most powerful financier in America, had to become the country's de facto central bank. Buckle up! Act 1. America's Golden Facade. The dawn of the 20th century, the United States was booming. Cities like New York were exploding upwards: skyscrapers, stock tickers, steel empires. Wages for industrial workers soared by 60% between 1880 and 1890, and real wages grew 40% in just 30 years. Immigration boomed. Railroads spanned the nation. Fortune makers like Andrew Carnegie and John D. Rockefeller were stacking gold. But beneath the glitter of the Gilded Age, America's financial system was a house of cards. Why? Because since 1836, after Andrew Jackson killed the Second Bank of the United States, America had no central bank. Thousands of tiny, underregulated unit banks dominated the financial landscape, restricted by law from opening branches across state lines. Reserves were pyramided in New York, a system so centralized that when Wall Street caught a cold, the whole country got pneumonia. Trust companies, like the Knickerbocker Trust, operated in the shadows with just 5% reserves compared to 25% required by national banks. They were profitable, fast-growing, and dangerously fragile. Act 2. The spark from the curb market. Enter F. Augustus Heinze, the swaggering copper king from Butte, Montana. Alongside his shady partner Charles W. Morse, a.k.a. the Ice King, Heinze tried to corner the market in United Copper stock on October 14, 1907. Here's the gambit. Heinze's firm tried to squeeze short sellers by buying up shares and forcing them to buy back at inflated prices. On Monday, shares jumped from $39 to $52. By Tuesday, up to $62. But by Wednesday, the price collapsed to $10, $15. Total disaster. Heinze's brokerage failed. His bank in Montana failed. He was forced out of New York's Mercantile National Bank. And just like that, fear spread like wildfire. Act 3. The Knickerbocker crashes. The spotlight turned to Knickerbocker Trust Company, run by Charles T. Barney. Barney was linked to Morse, and in the world of high finance, guilt by association is deadly. On October 21st, the National Bank of Commerce cut off Knickerbocker's clearing access, a death sentence. By October 22nd, there was a full-blown run on the trust. People lined up outside its Fifth Avenue HQ. It paid out $8 million in 3 hours before shutting its doors. Barney was ousted. A few weeks later, disgraced and shunned, he took his own life. Act 4. Panic in the streets, mayhem in the markets. Trust companies like Trust Company of America and Lincoln Trust were next. TCA hemorrhaged $47.5 million in just 2 weeks. Lincoln saw its deposits fall from $21 million to $6 million. Then the call money market, the lifeblood of Wall Street, froze. Interest rates surged from 9.5% to 70%, then to 100%, and even 150% in some trades. Brokers couldn't get financing. The New York Stock Exchange teetered on the brink. From its peak in 1906 to late 1907, the market lost nearly 50% of its value. Trading was minutes from being suspended. 8T5. Enter Morgan with no Federal Reserve. The U.S. turned to J. Pierpont Morgan, the 70-year-old titan of J.P. Morgan and Co. Morgan set up headquarters, not on Wall Street, but in his private marble library at 219 Madison Avenue. There, surrounded by oil paintings and mahogany, he played central banker to the nation. He personally organized a $23.6 million rescue pool for the NYSE on October 24th. Another $10 million the next day. A $25 million injection to save the Trust Company of America. A $30 million bond deal to prevent New York City from defaulting. And when bankers refused to cooperate, he locked them in the library overnight until they did. Morgan's lieutenants, like Benjamin Strong Jr., audited banks at lightning speed to decide who lived and who died. Act 6. Public and private power collide. Others stepped in too. John D. Rockefeller deposited $10 million into the Union Trust Company. Treasury Secretary George Cortelyou injected $37 million into national banks. Over $100 million in gold was shipped from Europe to replenish U.S. reserves. And then came Morgan's most controversial move. To save Moore and Schley, a major brokerage, he arranged for U.S. Steel to buy out its rival Tennessee Coal, Iron, and Railroad. It was a vertical monopoly move. He got President Theodore Roosevelt on board to waive antitrust concerns, all in a weekend. X7. The reckoning, the damage? Industrial production down 12%, 17%. Unemployment spiked to 8% nationally, over 16% in industrial sectors. Imports plunged 26%. Bank runs paralyzed cash payments across the country. In some areas, cash traded at a 5% premium over banknotes. But perhaps most important, the public had had enough. J.P. Morgan had saved the day, but at what cost? One unelected man holding the financial system in his grip? That terrified the public almost as much as the panic itself. ACT 8, birth of the Fed. Out of the chaos came reform. In 1908, Congress passed the Aldrich-Vreeland Act, leading to a full investigation. By 1913, under President Woodrow Wilson, the Federal Reserve Act was signed. The U.S. now had a lender of last resort, an elastic currency, the Federal Reserve Note, a central bank, the Federal Reserve System, with 12 regional branches and public oversight. The ghosts of 1907 were baked into its DNA. The panic of 1907 didn't just shake Wall Street. It reshaped America. It showed us what happens when ambition outpaces infrastructure, when speculation replaces stability, and when one man has to save the world because the system can't save itself. This has been the Maverick Podcast. If you enjoyed this episode, subscribe, leave a review, and tell your friends. In the next one, we'll be looking at how oil barons tried and failed to break the American antitrust laws. Until then, keep questioning, keep digging, and keep thinking like a maverick.